Welcome to the Money and Mortgages podcast. I'm your host, Adam Coleman, accredited financial counselor and mortgage planner. Join me as I speak with fellow industry experts on all things personal finance. Welcome, everyone. This is Adam Coleman, and my guest today is Kevin Lau, who's a certified financial planner and founder of Imagine Financial Security, a flat fee only financial planning firm out of Jacksonville, my hometown. Kevin, welcome to the show.
Thanks for having me on, Adam. Appreciate it.
Absolutely. Well, today we're going to be diving into the world of real estate investing, which not exactly a subject that many financial planners seem to gravitate towards. So I'm kind of curious to hear your thoughts there. But before we get started, tell us a little bit about you and your firm.
Yeah. So I started in the industry in 2008, obviously during the Great Recession. Really good time to be a finance major coming out of college. A lot of my business classmates went on to graduate school because there was no jobs. And I was really fortunate. I was at a career fair and one of my friends said, you need to go check out the financial services company. And so I checked it out and spent 6 years there. I met my wife there. I had a great time, but ultimately, I found out about this other way of doing planning. Okay, really through the XY Planning Network. Michael Kitces is from the area that I grew up in Northern Virginia. So I'd heard about this other way of giving advice, this fee-only way of giving advice that really attracted me really back in 2013. I'm like, hey, this is what I want to do, but I can't do it today. I just had a lot of fear. I just was uncertain, what that environment looked like. So I spent another 6 years working for more of a hybrid wealth management insurance firm and bank. And that was amazing to sort of cut my teeth more on the comprehensive financial planning side as opposed to just insurance sales. And 2020, I thought, hey, this is a really good time to start a business. I have 3 kids under the age of 2. What better time to start a business now at the height of the pandemic and with 3 little ones. So
Right.
Here we are 3 years later, we're still standing. So that's a good thing.
Well, congrats on that.
Appreciate it.
Well, I mentioned it before. So a fair amount of financial planners tend to, I think, shy away from real estate investing. I think it's just not their bread and butter. I think investments and, standard mutual funds, ETFs, that whole thing is kind of their standard go-to option when it comes to investing. But you're a little bit different where you take a different approach. So I guess why is that, and what made you gravitate towards real estate investing?
Yeah, I think just really my personal experience investing in real estate. I mean, I kind of just had these aha moments. And you're right. When I was new in the industry, 2008 to 2012, and, I had mentors at my firm that were like, real estate's a terrible investment. It only appreciates at 5% a year. Stocks will appreciate at 10% a year. So just don't even worry about real estate. If clients ever want to talk about real estate investing, just say, hey, you're better off putting the S&P 500 index fund. And so on the surface, that may feel true or seem true, but once you really understand the mechanics of how the returns work on real estate, how the tax benefits work, how it can serve as a diversification tool. I, again, experience investing in real estate myself, having bought my first property in 2016, my second in 2020, plan on continuing to do that now, especially as the business is up and running, continue to add more properties just as a diversification tool for me. Everyone has their own reasons investing in real estate. Some people that I know, they go all in on real estate investing. They don't even buy traditional securities like, index funds or mutual funds. They go all in on real estate. For me, I like to take an approach of diversification, obviously being a financial planner with my background. So obviously my home run investment is into my own business, growing the valuation of my practice and my business long term. The second in my eyes is my real estate investing. The third is my traditional stocks and mutual funds, and ETFs, those types of investments and my fourth is my good old cash value life insurance. So that's really those are the 4 tools that I use to build wealth myself. And, again, it's not for everybody, but I think that's really why I sort of said, hey, this actually could make sense in the context of an overall financial plan for especially the markets that I'm serving that are Gen X, Gen Y entrepreneurs or super high income. They're easily able to max out their 401ks or their qualified plans. They're just looking for other places to invest. This could be one of those buckets that you look at filling up.
Nice. Well, and there are several options to go into. I mean, tons of different ways to get into real estate investing. I mean, you've got kind of traditional single family home, just buy it as a rental property, buy and hold as a rental. You got house flipping, Airbnb. You can go into like REIT investing, so real estate investment trust investing, or house hacking is another one. I guess all of the above, and then even to the extreme of commercial real estate investing. So what do you like and dislike about any of those options more than others?
Yeah, first, just as a disclosure to the listeners, like, I'm still in the learning process of the real estate game. There's so, like you said, there's so many ways to invest in real estate. I haven't experienced an Airbnb. I haven't experienced in doing, flips. I have clients that do that type of thing, and I have other colleagues and friends and family members that get into that type of investing. And so I think, real estate is some of those things that like there's so much to learn. I've really found a lot of value in just the Bigger Pockets community, the podcasts, the books that they put out. So that's really where I've garnered a lot of my knowledge with real estate. But, yeah, I mean, I think every type of real estate investment is going to have different risks. It's going to have different upside, different downside. It's going to have different tax benefits. And it's also going to suit certain types of investors. There's certain types of investors like, hey, I want to be super passive. I don't want to, I don't want to go out and receive phone calls from the tenants to to fix a toilet or to fix whatever it might be. I don't want to deal with that type of thing. I want to be super passive with my investing. So that might be a little bit different than someone who wants to actually get out there and flip homes and find deals that are off market, that are below market value. That's really where you can hit a lot of home runs, is by finding the right properties. And you're just not going to be able to do that if you're just kind of passive and you're looking at deals in the MLS or in Zillow. It's just
Right.
very hard to do that. You can still be very successful. That's how I bought both of my properties, is on traditional MLS. But there are many different ways to investing in real estate, and you got to just, my suggestion to people is like, do some research, listen to podcasts, read books, talk to people that have done different types of real estate investing, and see what kind of resonates within your overall portfolio and how it could fit with your lifestyle as well.
Well, and I think you did, and correct me if I'm wrong, I think you did it the way I would envision people starting off with it, is basically you bought a house as a primary residence, and then you eventually moved out to a different house, and then you kept that one as a rental, correct?
That's correct. And we're in the process of doing the same thing again to our current house. So we're going to turn this one into a rental as well. And that's one of the that's in my opinion, one of the lowest risk ways to invest in real estate. Buy it as a
Right.
primary residence. You get the best mortgages, on those properties, as you know, Adam. And long term, after you let that property season, now you've even paid down a little bit of your principal. Now you've even more equity in the property. Maybe real estate, maybe interest rates change over time. Like right now, we're in a high interest rate environment relative to the last 20 years. Maybe rates do come down and you're able to do a refinance. So it's a really, it's in my opinion, it's a very low risk way of investing in real estate, because you've owned it as your primary residence. You know the area, you like the area, you like the property enough where you lived there, and then you could, if you want to, turn it into a different strategy. I'm in the process right now to turning my first one into a short-term rental right now. And then the property we're in now, we're going to turn this into a long-term rental, because they don't even allow short-term rentals based on the HOA bylaws. But yeah, that's worked for me. If I had a lot more time to invest in real estate, like I said, I have 3 little kids. I run a business. I don't have a lot of time to go out there and like find deals myself off market. If I had more of that time, maybe I do more flips, or I do more burr properties. But for right now, where I'm at in my life, this is a great strategy for me.
Nice. Yeah, I mean, I think that's the big key is I hear too many people talk about, oh, it's passive investing. It's like, it's not passive. Like there's some work to be done, especially if you start getting
Mm.
into some of this stuff. Like it's definitely takes on a whole nother job of itself. But I think the way you're
Yeah.
doing it is certainly the cleanest way and probably the simplest way to get your foot in the door of real estate investing for sure. I mean, house hacking would be another
Yeah.
option that I've seen
Oh
people
yeah.
have success with. It just takes a certain type of person that wants to go through that, because it's sometimes not the easiest thing to do, especially with your first house, because a lot of people
Yeah.
do that to buy a multi-unit property.
House hacking. I had a friend of mine that did this, right after college. He bought a house. It was a regular single family home, and he just rented out several of the rooms, and they were essentially not
Right.
only paying his mortgage, but he was also pocketing a little bit of cash flow. And so he was, he had a cash flowing property right off the bat. He had a really preferred mortgage interest rate. He was building equity by way of paying down his principal, and then he's obviously enjoyed appreciation since then too. So you don't necessarily just have to do a multifamily to do a house hack. You can even just do a regular single family home. Now, it doesn't work if you're married with kids. That obviously is not going to
Right.
work. Your spouse is probably not going to be down with some random tenants in your home. But if you have a duplex or or quadplex, there are those opportunities there where you can rent a separate unit. And that's one of my favorite recommendations, like unsolicited recommendations for people on the street that I talk to about like just investing in general. I'm always like, your first property, find a way to house hack. Like get a
Right.
duplex, get a quadplex, live in one of the units, rent out the others. And especially now, with these preferred mortgages with some of these multifamily homes, I mean, you could probably, enlighten the audience a little bit better than I can, but I think you can get away with putting only 5% down on a conventional loan with the multifamily property, which is pretty powerful in my opinion.
Yeah, I mean, and that's a recent change. I mean, it used to be pretty restrictive where you had to have like 15 to 20% in a lot of these cases.
Mhm.
FHA was always kind of the go-to house hacking option where you could put 3.5% down, but there's some downsides to FHA, and it can
Yep.
be pretty tricky to qualify with FHA for a house hack nowadays. But yeah,
Yeah.
they did improve that quite a bit where, I mean, 5%, you can buy a 2 to 4 unit property, rent out the other ones. If you're down for it, then you can make some good money doing that. It does take
Yeah.
some work. I mean, I'm certainly not going to be like other mortgage people and be like, yeah, that's the best thing for everybody to do.
Mhm.
It definitely takes a certain type of person to be willing to go through that. But especially younger,
Mhm.
like if you're younger and you don't care about
Yeah.
living right next to somebody, like share a wall with somebody, I think it's a great option for a lot of people, and probably
Huge.
legitimately the only way a lot of people can honestly afford a house in this market with the rates
Yeah.
being higher and property values being higher. Like it'd be
Yeah.
tough for a lot of people, especially for a first time home buyer. So it's
Oh
a good
yeah.
way to go into it. But yeah, no,
Absolutely.
you're doing it the way I kind of wish I had done it myself. I always kick myself for not keeping my first two houses and renting them out, because it would have been such an easy process. Had like a 3% rate on them and then rent them out.
Mhm.
And you take advantage of the primary rate, residence rates on those instead of the rental property. You can't go wrong there. If you've got a decent house, you know you've lived in there,
Yeah.
so you kind of know
Yeah.
the pros and the cons. You obviously picked it for a reason, so
Mhm.
you'd like that house for a while. So it's not going to be
Absolutely.
too shocking to think that you can find somebody that's going to like it to rent it out, especially in this market.
Yeah, I mean, like back in 2016 when we first bought that house, like did I have that mindset like, hey, we're going to turn this into a long-term and then a short-term rental?
Right.
Not really. I mean, I always kind of felt like, hey, we're like we were buying in the number one school district in Florida. We knew it was a very desirable county in the state of Florida. So that obviously, that checked off that box. It's in a very, great proximity, very close to the beach, splash parks, all the amenities in this neighborhood. So in my mind, I'm like, this is a great buy. You know what I mean? Like, and looking at the prices back then, I mean, I bought that house for $312,000 back in 2016. The current value is over 550. I mean,
Oh yeah.
that's insane. The appreciation, I mean, that's 76% total appreciation over that 7 years. Now, a lot of that came in 2021, 2022,
Sure.
2023, when the pandemic and the migration from New York, New Jersey, Pennsylvania, all the northeastern states to Florida. But ultimately, I always kind of had this feeling that this is a great long-term play, and it just so happened like we made a move after we went from 1 to 3 kids. We were like, hey, we just need extra bedrooms. I'm working from home full time. We just needed a different kind of
Right.
space. And I kind of had to convince my wife to do this because in the beginning she was like, hey, you're starting a business. Like, let's just sell the property. Let's get the cash. Let's stay liquid. And in my mind, I'm like, let's just try it for a year. Let's rent it for a year. If it's not working, then we'll sell. And well, that year was 2021 when the home prices went up 30+% in my county.
Right.
So, she was like, hey, that was a great idea, and she kind of thinks it was her idea now. So, which is fine with me. And so I think she's kind of bought into the idea of, real estate as an investment. And again, not sort of the be all end all, but as a piece of the puzzle of an overall financial plan. It could be a great complement to other things that your audience is doing, and then certainly for my family that we're doing as well.
Right. Well, no, and it kind of brings up the next topic is like, who do you think would be the best candidates to get into real estate, and probably who shouldn't at this point?
It's a good question. I mean, I would say who should get into real estate. I mean, I think anyone who's legitimately trying to build wealth and wants to do it in the most diversified way possible. I like to use that core four analogy all the time, especially for my entrepreneurs. You've got your business valuation, that's your home run bucket. There's going to be no rate of return anywhere you can find that's going to generate the multiples in your business.
Right.
But I would say real estate is number two. At least for me and my experience personally with my properties, real estate would be number two as sort of like that home run type of bucket. If you buy the right property, it's all about buying the right deal in the right location and having a long-term mindset. So I'd say anyone who doesn't want to have a longer term mindset probably should stay away from investing in real estate, especially with the high interest rate environment we're in today. It's much harder to find deals. Like I'm talking to
Right.
investors right now that are like that have been super active investing in real estate. They've been kind of slowing down over the last year just because the deals are harder to find. They're still out there, but they're harder to find. But I think that could start to turn a little bit. I was having this conversation with the property manager that we just hired for our other house that we're turning into a short-term rental because we're switching strategies. And St. Augustine is 15 minutes from my house. Okay, so he's very very familiar with the St. Augustine market. There's been sort of like a plethora of investors flooding into St. Augustine to buy these short-term rentals and trying to Airbnb them, and especially the ones that have bought over the last 1 to 2 years, he's just saying like all of them are cash flowing in the red because of how high interest rates were, how high the home value was, and now with the competition, markets that are really, really saturated and have a lot of competition for other short-term rentals or whatever you're competing against, that is a factor. So I think you could start seeing some of those investors try to offload their properties, and there could be deals to have. And so I think if you're out there, you're kind of like, hey, should I get in now? I mean, absolutely. If you have a long enough time horizon, it doesn't matter that interest rates are high now, because as you know, Adam, what's like the phrase that you all like to use in the mortgage industry, you marry the house and date the rate or whatever. I think that's what it is. And so,
Not going to catch me saying stuff like that, but that's fine.
But that's what I hear a lot of mortgage people talk about. It's like, but that kind of makes sense. Like, if you buy a property now, you might be overpaying just a little bit relative to a few years ago, for sure.
Yeah.
And your interest rate's probably higher than you like. So cash flow, you might kind of be in the red for a little while. But let's say you have a year or two and you have a couple of tenants turnover. Now you're able to raise rents, and now you've paid down some of your mortgage. Now also potentially rates have either leveled or come down. Maybe you can do a cash out refinance, take some of your equity out, have a lower interest rate, and now you could be cash flowing in the black. And so if you have a long enough time horizon, it could be a viable strategy for just about anyone. But certainly for folks that are higher income, or let's say they're entrepreneurs, they're looking for a way to shelter some of their dollars from taxes. They're looking for a way to build wealth outside of your traditional stocks and bonds or mutual funds or ETFs. It's certainly a great complement to what those folks are doing outside of their business ventures.
Right. Well, and that's a good segue. So obviously the big question in a lot of people's mind is like, all right, do I want to go heavy in real estate investing, or do I want to focus, just invest it in stocks and bonds, mutual funds, whatever? How are you comparing those? Because in terms of, numbers, if you're super analytical, how are you differentiating the two to try to rationalize the return on investment that you could get? Like you said, stocks and bonds or stocks over course of time have averaged about 10%, real estate not as much. So what numbers are you using to make that analysis?
So investing in kind of like your traditional basket of ETFs or mutual funds, right? I mean, there's like, it's what's like the terminology now. It's like kind of like the lazy way to build wealth, but a very viable way to build wealth. It's like max out your 401k plan, max out your HSAs, max out your Roth accounts, make those super aggressive into ETFs and index funds. Like, that is the most passive way you can build wealth. And those are the traditional folks that I'm serving with my practice that are closer to retirement. I kind of have like two segments of my practice. I have like your traditional retirees that have built wealth inside of these traditional 401ks and IRAs. And then I've got this growing segment of my client base that's more the entrepreneurial Gen X, Gen Y, kind of like folks like me that are trying to build wealth with traditional investments, but also with their business ventures, and then also with real estate. But I think if you want to look at some of the numbers, I think that the biggest thing with real estate for me is like, you can't just look at appreciation as like the benchmark, where it's like, hey, home values over time. Like, I looked at stats before we had this conversation, like roughly 4.4% a year. It seems like nationwide is the average price of home values going up. Last year, if you looked at Florida, we saw a 5% increase from December 22 to December 2023. So 5%, if you compare that to, let's say, the S&P 500 in 2023, it lagged by 21%. Okay.
Right.
But if you ignore the leverage, okay, on the property, that's your problem. Okay. And that's why I think a lot of my mentors, when I first got started in the industry, they're like, hey, 5% versus 10%, no brainer, invest in the S&P 500. Well, that's not apples to apples, because I didn't put 100% of the home value price with my down payment. I maybe only put 20% down. So now you're using 80% of somebody else's money, but 5% is on the total value. So if you really look under the numbers here, I just did a little back of the napkin in Excel. Okay. So the average home price in the state of Florida in December of 2022 is $383,610. The average home price in 1 year later, in December of 2023, was $403,800. So that was a 5% increase in home values in the state of Florida. Let's say someone put a down payment of 20% down in 2022, therefore they put $76,000 down of their own money. Okay. But if we have a $20,000 increase in the value of your property, your cash on cash return is significantly higher than 5%. Well, what is it? Well, you also have to factor in another way you can make money in real estate, and that's paying down your principal. Okay. So in that situation, someone took out a 30-year mortgage at 7% roughly. They also pay down about $6,000 in principal on their mortgage. So not only do your home value go up 20 grand. You also had $6,000 of paying down your principal. So now your total return, roughly, assuming no cash flow, by the way, because this market, probably assuming no cash flow for most deals, your total return is 26,490. If you look at a cash on cash return, that's 35%.
Right.
Very tough to replicate that. And that's just 1 year. You know, if you look at a longer term horizon, it could fluctuate, obviously. You know, 2023 wasn't a stellar year for real estate. It was fine. It was okay. 5%, that's kind of around the average, right? I did the same thing for my property, the one I bought in 2016, annualized rate of return of 58% a year. Okay, if you're factoring the leverage, very hard to replicate that investing in index funds, ETFs, mutual funds. I could replicate that in my business, and my business valuations exceeded that multiple. But that's why the real estate's so powerful, is because you have the leverage, and then you also have the tax benefits, which we haven't gotten into that yet either.
Well, and that's the next question. So maybe speak to that. So what are kind of the major tax considerations for people going through real estate investing? Because that's obviously a big one.
Yeah, I think like the general for most people getting into real estate, and like for me personally, I'm a passive investor. Okay, I'm not a real estate professional. I don't have active participation in my investment, so I'm a passive investor. So I'm limited on using my passive losses from my real estate activities to offset only passive income, which is fine for me. That's not the main reason I'm investing in real estate today. But the tax benefits, it really comes down to depreciation and expenses. Okay. So, obviously, we're collecting rents from our property, but essentially, once you factor in the expenses, which is your mortgage, your interest, your taxes, your insurance, your maintenance, your repairs, all of those things, a property manager, and then you add on top of that depreciation, okay, which most properties are going to be depreciated about 27 and a half years. So you take the property value excluding the land, okay, so just the building value, divide that by 27 and a half, and that's roughly what you could take as a deduction each year on that property, right when it goes into existence. So that comes into about 3.6% per year of the property value. Once you factor those things in, I'm not showing any income. Even though my property is cash flowing positive, I don't show any income on my tax return from my rental income. And that's nice, because essentially I can just offset any income that I'm earning. It goes to zero. Okay. And then long term, I have capital gains taxes. Okay. So just like stocks, mutual funds, if you hold it for long term, longer than a year, you have capital gains taxes. Less than a year, then you have a short-term capital gains taxes. And so that's a nice benefit, in addition to the step up in basis when I pass on and I leave this asset to my children. They're going to get that step up in cost basis, just like you would with a stock, bond, or traditional mutual fund. Okay. That's kind of, most people are going to have that tax benefit. But I think if you can take it to the next level, and this is sort of where I'm thinking later on in life, particularly for my wife, because she used to be a realtor. And right now she's like time and a half with the kids, 3 boys under the age of 5. It's kind of crazy in my household, but long term, becoming a real estate professional, having material participation in the property, then you can actually look at potentially using those active losses from your real estate investing and offset other income, like from my business. And that's where really it can get crazy. And that's where you hear a lot of people like, oh, well, Trump paid 0 in taxes, or, Robert Kiyosaki, he pays no taxes, but he's making millions a year. That's why. Okay. Because the real estate professionals, they spend the majority of their time investing in the real estate activities, and it's more so than any other activity that they're participating in. But that's kind of next level. And that's something I'm looking at as well for myself.
What are the main requirements or stipulations for that?
Yeah, so you may want to put this on the show notes. So I'll send you a link that I'm looking at right now. But essentially you need both of these criteria in order to qualify. Okay. Number one, more than half of the personal services performed by the taxpayer during the tax year must be performed in real property trades or businesses, okay, in which the taxpayer materially participates. Okay. So that's number one. And then number two, the taxpayer must perform more than 750 hours of service during the tax year in real estate, property, trade, or businesses in which the taxpayer materially participates. Okay.
Gotcha.
So my business is way more than half of my time, so I could not qualify right now. Okay. My spouse, my wife, once our kids are in school, she could absolutely qualify. If she's spending more than 750 hours of services on real estate, on those investments, and that represents more than half of her services performed during the year, she could be golden. Okay. Now, obviously, there are other things as well for material participation, but I think those are things that you need to kind of look at and see, hey, can I take advantage of this, or can my spouse take advantage of this? That's what I see a lot of my entrepreneurs do, where like, let's say one spouse is kind of running the business and the other spouse is maybe helping a little bit, but maybe they have time to focus their efforts and energy on real estate investing. It could be such a powerful tax play if you have a real estate professional in the household.
Gotcha. Now, and they don't need to be a real estate agent or anything. It's just related to the time, just those two stipulations
Yep.
that you talked about.
Correct. Yep.
Right.
Correct.
Nice. No, that's good information for sure. Well, and we kind of talked on this already a little bit, but easiest methods to get into real estate investing for people that don't have experience with it. I think you kind of already mentioned that. Basically, you convert your existing primary home to a rental when you move out. Anything else, I guess, that you would think would be a good, starting off point for people?
I mean, I would say partnering with someone who's done some deals. I would say that would be my top recommendation. In addition to doing your own research and education, find someone who's done some investing on their own and say, hey, I would love to do a deal with you, and figure out a way to make it work, whether it's you bring the down payment and they do the heavy lifting and you get to watch them in action. I mean, this is kind of like part of the education process, is seeing deals in action. So that's what I'd recommend, is like partner with someone who's done it before, that's doing properties, especially the ones that you want to get into. If you want to get into Airbnb, find someone who's doing Airbnbs. If you want to get into flips, find someone who's doing flips, and see if you can partner in 1, 2, or 3 of those, and then you can kind of go out and on your own and maybe do 1 or 2 on your own, and it is really put this into action, and like learn by doing is what I like to do. Like, I think there's a lot of time people can kind of have this analysis by paralysis. From my perspective, it's like, life's really short. We don't have a lot of time on this earth, and it's like, the more time you can spend doing as opposed to thinking about doing, the shorter your learning curve is going to be. And so that's what I'd recommend, is like, find someone that you trust, that you could potentially partner with, and that is probably your easiest way to get into real estate. And then obviously, like we talked about, converting your existing primary, but even just buy and hold long-term rentals. Like, even if you're like, hey, I'm going to cash flow negative for the first year or two, but again, don't have that mindset. Even if your property is like minus $100 a month of cash flow in the first year or two, you're still having equity built up because the property is being paid down by your renters, your tenants. Okay. Right. So you still can have a positive rate of return, even though the cash flow was in there. That's one of the biggest mistakes I see people make, is like, they're just investing for cash flow.
Right.
If that's your primary goal in this market, it's going to be tough to do that. It might take 5 or 10 years for those properties to season in order to get there. But if your primary goal is to say, hey, I want to build wealth, there are opportunities out there in this market.
Yeah, especially with the principal pay downs and the tax deductions and things like that. Like you said, it is hard to cash flow sometimes, but that's not the end all be all. Certainly when there's all these other different, stipulations that come into play. So
yeah, totally.
Do you like the idea of people focusing more on their local markets, or do you think it really matters?
It depends on your local market. I mean, if you're out in like the Bay Area, like San Francisco, I mean, yeah, you've got to have some capital to get some. I mean, you're like looking at a starting point of a couple $1,000,000 versus if you're out in California, you have high salaries, out in San Francisco, and you're like, hey, I'm going to look at a different market. It probably opens the door to more buying opportunities. The only thing I would say is, just like the word of caution, is make sure you have the right team if you're investing out of market. And so like that team would be kind of like your property manager, general contractors, real estate professionals, lending, obviously the financing is important as well. But, if you find a really good property manager that is willing to partner with you, they're going to know real estate. They're going to know general contractors. So like, I feel like the property manager is kind of the key. And once you find a really good 1 or 2 of those in a certain market, totally comfortable with investing out of market. I haven't done that personally, but I know people personally that have done that, and with a lot of success.
Yeah, I've seen it all across the board. I mean, agreed. You kind of have to have that property manager relationship, and you need to understand that you're not going to be managing it yourself, obviously, clear across the country. So there is a fee that goes into it. But honestly, even locally, I don't know if I would want to manage it myself either. I'd probably want a property manager to deal with a lot of that stuff too. So it's not that big of a difference. But yeah, to kind of button everything up, any other, I guess, common mistakes or anything else that you see people deal with that would help to avoid if you're going down this real estate investing path?
Yeah, I mean, I would just say, like, and kind of like when I talk about with any investing, it's like, following the crowds, like that's generally what you want to stay away from. And that was kind of what I touched on with the St. Augustine, this Airbnbs, like just popping up left and right. And now people are cash flowing in the red. And now they're like, what happened? I thought this was a great investment. It's because everyone else was doing that over the last 3 to 4 years and loading up on these Airbnbs in these hot markets, and anyone could make money in those markets. And so, just kind of be careful with like following the crowds and like, what are the crowds saying right now? Real estate is a terrible investment because interest rates are so high, you're going to lose money. That's actually for me, and that's where I want to actually like kind of open my eyes, like, where are these opportunities coming? And especially having this conversation with that property manager that's taking over for my short-term rental, what he said, it's like the perfect example of like all these people that are dissatisfied with following the herd and now they're trying to get out. There's your buying opportunity right there. And so, it's kind of like the Warren Buffett quote I like to throw out there all the time. It's like, be fearful when others are greedy, and then be greedy when others are fearful. I think that resonates so much with any type of investing. I'm not talking about just being greedy. I'm just saying when people are afraid, that's when there's opportunities. And when people are not afraid, that's usually when you want to pump the brakes and potentially kind of say, hey, let's sort of like filter through what's going on and maybe, proceed with caution.
Right. Well, no, Kevin, that's been a pleasure. I appreciate you taking the time and kind of going through all this stuff. I don't get this from a lot of the other financial planners. So this is really helpful information and good firsthand knowledge too. So I hope things go well with the short-term rental for you. But if somebody wants to learn more about you and your services, what's the best place to find you?
I would say, I would say my Instagram, connect with me on Instagram. Imagine Financial Security is my handle on there. So I do a lot of my, talk for, entrepreneurs, high income millennials, high income Gen X, real estate investing, those types of things I do on my Instagram. So that'd be the best way.
Nice. Well, Kevin, it's been a pleasure. I appreciate you taking the time.
Hey, Adam, thanks for having me. Appreciate it.